Ever stared at your crypto portfolio and felt that knot in your stomach thinking about taxes? You're not alone. Millions are scrambling to avoid IRS headaches in 2025. But what if I told you understanding crypto taxes isn't a nightmare, but a shield for your gains? Let's cut through the chaos and arm you with what you really need to know. Breathe easy for a second. Crypto isn't taxed like some mysterious black box. It's treated as property by the IRS, just like stocks or real estate. That means every time you sell, trade, or spend your Bitcoin or Ethereum, it's a taxable event triggering capital gains or losses. Picture this. You bought ETH at $2,000 last year, and now it's $4,000. Sell it? Congrats, you've got a $2,000 gain to report. But hold for over a year and it's long-term, taxed lighter. In 2025, short-term gains, under a year, hit your ordinary income bracket, 10 to 37%, while long-term caps at 0 to 20% based on your earnings. The IRS isn't playing around anymore. Starting January 1, 2025, centralized exchanges like Coinbase must report your sales on the new Form 1099-DA, sending copies to you and Uncle Sam. That's gross proceeds for now, no cost basis until 2026, but it means hiding trades is tougher. DeFi platforms dodged the broker bullet in March 2025 when the Senate axed that rule, so DEXs like Uniswap won't report yet. Still, you self-report everything on Form 8949 and Schedule D. For everyday folks like you, juggling a 9-to-5 and side hustle staking, this clarity means no surprises, just smart planning. Take Sarah, a 32-year-old marketer. She traded $5,000 of BTC for SOL mid-2024, forgetting it's a sale at fair market value. Boom! Short-term gain taxed at her 24% bracket, adding $800 to her bill. The fix? Track every move from day one. Tools like spreadsheets or apps make it painless, turning tax dread into a routine check-in. And here's the empathy. We've all been there, eyes glazing over spreadsheets, but nailing this protects your hard-won portfolio from audits that could drag on for years. One more layer. Income from mining, staking, or airdrops counts as ordinary income at receipt value. Staked $1,000 ETH yielding $100? Report that $100 now, even if you hold the reward. Missouri's ditching capital gains on crypto this year, a win for residents, but federally, it's business as usual. Feel that relief? Knowledge like this shifts you from reactive filer to proactive builder. Now let's roll into the taxable events that trip up most people, because spotting them early keeps your returns intact. Selling for fiat? Obvious gain or loss. But crypto-to-crypto swaps? That's a silent killer. The IRS sees it as selling one for dollars, then buying the other. Swapped Doge for SHIB? Calculate the gain on Doge at swap time. In 2025, with volatility wild, a quick trade could mean thousands in unexpected taxes. Spending crypto counts too. Buy a coffee with BTC? It's a disposal at current value. Even gifting over $19,000, 2025 exclusion, triggers reporting, though no tax if under. NFTs? Minting might be income, selling is capital gains. DeFi lending? Interest earned is ordinary income. John, a 28-year-old developer, ignored his Uniswap yields in 2024. $500 hit him with a CP 2000 notice, proposing extra taxes plus interest. Heart sinking? Yeah, but he fixed it with records, owing less than feared. The curiosity hook. Why does this matter now? IRS letters surged in 2025, targeting underreporters with blockchain sleuthing. Non-taxable moves? Wallet-to-wallet transfers or just hodling, no event until disposal. Forks without new coins? Zero tax. This isn't overwhelming, it's a map. Pause, review your last trade. Did it trigger? Awareness alone slashes audit risk by 80% per tax pros. But wait, calculating cost basis. That original purchase price plus fees feels like math homework from hell. For 2025, you're on your own records, no universal method anymore. FIFO, first in, first out, is default, but specify HIFO, highest in, first out, 4 bigger losses if your software supports it. Emily, a freelancer, used FIFO on her mixed buys, overpaying $1,200. Switching to specific ID, picking exact lots, saved her bundle next year. Tools shine here. Import to Coinly or CoinLedger, and it auto-calculates, tagging short/long term. With 1099 DA incoming, mismatches scream audit. The transformation? From frantic Googling to confident filing, freeing mental space for life beyond ledgers. Remember, losses offset gains dollar for dollar, carrying forward indefinitely. Harvest them strategically before year-end. Pro tip: no wash sale rule yet for crypto, so sell at a loss, rebuy immediately, and deduct fully, unlike stocks. Biden's 2025 budget pushed it, but it stalled. Imagine the edge. Mike turned a $3,000 dip into a deduction, buying back and sleeping better. This isn't loophole hunting, it's playing fair while smart. Speaking of pitfalls, let's confront the mistakes that could cost you big, because ignoring them feels like ignoring a check engine light. Top 1. Forgetting crypto-to-crypto trades are taxable. Swaps aren't free, they're disposals. In 2025 audits, this topped IRS flags, per CPA report. Fix: log every swap's FMV via CoinMarketCap timestamp. Second, skipping income reports from staking or mining. That 5% yield? Taxed at receipt, not sale. Airdrops? Income too. Lisa overlooked $400 in rewards, faced 20% negligence penalty. The sting? Avoidable with auto trackers. Third, shoddy records. No basis proof? IRS assumes zero cost, taxing full sale as gain. With wallet-by-wallet tracking mandatory soon, scattered CSVs won't cut it. Common trap: thinking DeFi's invisible. It's not. Self-report or risk fines up to 75% of unpaid tax. Put yourself here. Audit letter arrives, heart races, but your exported reports? Bulletproof. Shift happens when you treat records like insurance. Boring until invaluable. Emotional peak. That audit fear? Real, with IRS hiring crypto forensics teams. But 90% resolve with doc. Diversify errors too. Don't lump all in FIFO if HIFO save. The relief? Compliance as empowerment, not punishment. Finally, arm yourself with tools and strategies to conquer 2025 taxes, because manual math is a relic. Crypto tax software like CoinLedger or ZenLedger imports from 500+ exchanges, calculates basis, and spits IRS-ready forms. TurboTax compatible. Coinly handles DeFi/NFTs seamlessly, generating Schedule 1 for income. Free tiers preview gains. Paid $49+ unlocks report. Strategies? Harvest losses year-round. Offset up to $3,000 ordinary income annually. Donate appreciated crypto to charity. Deduct FMV, skip gain tax. For high earners, opportunity zones or Roth conversions, but consult a CPA. Tom, a trader, used ZenLedger's harvesting. Cut his bill 30%, funding a down payment. Global twist. OECD's CRF means international reporting ramps up, but for US folks, focus domestic. Start now. Sync wallets, run a mock report. That forward motion? It's the promise of turning tax season from dread to done, wealth intact. We've mapped crypto taxes. Property rules, key events like swaps and staking income, basis math, pitfalls from unreported trades, and tools for seamless filing. With 1099 DA hitting in 2025, compliance isn't optional, it's your edge. Harvest losses, track religiously, and act now. Knowledge like this doesn't just save cash, it secures your future. Log your trades today, small step, massive payoff. Check the description or the first pinned comment. because I left some useful links and exclusive recommendations for you. And since you stayed until here, YouTube chose the best video for you to watch now. It's on screen for you.